Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, tax strategist, and today we're demystifying digital assets for small business owners. Fast disclaimer, this is education, not personal advice. Talk to your own pro. The headline rule is simple but powerful. The IRS treats digital assets as property, not currency. That means property tax rules apply. Basis tracking, realization on disposals, and capital versus ordinary character depending on the activity. Once you bring crypto into your business, those rules can touch sales, payroll, inventory, financial reporting, and even your internal controls. My goal is to translate the rules into practical steps, highlight planning opportunities, and help you avoid the traps that lead to penalties, overpaid tax, or painful audits. First, accepting crypto as payment. When you receive a token for goods or services, you recognize ordinary income equal to the US dollar fair market value at the time you have control. That amount becomes your basis in the coin. If you later hold and dispose of it for more or less, the difference is a gain or loss. Volatility can create surprise swings. So many merchants auto-convert to dollars immediately to lock value and simplify books. Sales tax doesn't change just because payment came in crypto. Valuation simply sets the taxable sales price. Use a point of sale or processor that timestamps receipts, captures quotes and fees, and exports clean data to your accounting and tax software. Are you an investor, a dealer, or using crypto as part of ordinary operations? Investors typically have capital gains and losses on disposals, with long-term treatment after a year. Businesses that primarily acquire crypto to resell to customers can be dealers, producing ordinary income and possibly inventory accounting. Fax rule: a cafe that accepts coins at the register and converts is not a dealer. A market-making desk likely is. If crypto is your product, spreads are ordinary and can trigger self-employment tax for sole proprietors. If crypto supports operations, like paying vendors or holding short-term working balances, treat it like any other non-cash property on your books and keep clean separation from personal wallets. Basis and lot selection are where planning pays. Every acquisition needs a date, quantity, and dollar cost, including fees. On disposal, you can generally use specific identification if you document the exact units sold, addresses, TX hashes, timestamps, and price source. Without that, FIFO applies by default. Specific identification lets you harvest losses from high basis lots or lock in long-term gains strategically. Keep meticulous records, API exports, screenshots, reconciliations, and a written policy naming your valuation sources and cutoff times. Choose crypto tax software that integrates your exchanges and self-custody wallets and pushes summarized entries to your general ledger for a defensible audit trail. Let's separate book from tax. New GAAP guidance, FASB ASU 2023-208, moves many crypto assets to fair value with changes through earnings. Your financial statements may now record unrealized gains and losses each period. For tax, most businesses do not mark crypto to market. Taxation generally occurs when you dispose of property or earn it as income. The mismatch creates deferred tax items and explanations for owners and lenders. Maintain schedules that bridge book and tax, including opening balances, realized versus unrealized activity, impairment history under old guidance, and wallet designations for business versus personal. Clear reconciliations reduce surprises and speed any future audit or due diligence. Reporting hot sheet. Every business return now asks a digital asset question. Answer it completely. Dispositions of investment crypto go on Form 8949 and Schedule D. If activity is part of your trade or business, income and expenses belong on Schedule C, and some sales of business property flow to Form 4797. Paying or receiving compensation in tokens is still reported on W-2 or 1099, using the dollar value when paid. The IRS is rolling out broker reporting on Form 1099-DA. Expect more matching notices. Reconcile your realized gain reports to exchange statements and your general ledger, and keep work papers showing lot selection and price sources. Let's talk payroll and payables. Paying employees in crypto does not change payroll taxes. Withhold based on the dollar value at the payment time, deposit timely, issue a W-2, and include state items. For contractors, you generally do not withhold, but you must issue Form 1099 NEC using the dollar value when paid. Volatility between approval and settlement can distort comp, so consider auto-conversion to dollars or same-day policies. Use a compliant payroll or payables platform that supports digital assets, timestamps payments, records fees, and produces audit trails. It also helps reconcile fringe benefits, state unemployment, and workers' comp calculations. Mining, staking, and node operations have unique timing. Generally, when you have dominion and control over rewards, you recognize ordinary income at that dollar value. If you run a trade or business, that income can face self-employment tax. Expenses like equipment, hosting, electricity, pool fees, and software are deductible. Larger rigs may be capitalized and depreciated under Section 168, with potential bonus depreciation. Keep separate wallets and dedicated meters where possible. Profits may qualify for the qualified business income deduction, subject to thresholds and wage or property limits. Draft clear agreements if multiple owners share nodes and document allocation of rewards and costs. Airdrops and hard forks trigger income when you can control and value the tokens. If a fork creates a new chain and units hit your wallet Tuesday at noon with a quoted price, that's ordinary income then, and it becomes your basis. Staking reward timing follows the same control principle. In DeFi, most token-for-token swaps are taxable dispositions because you exchange one property for another, including moves into stablecoins. Liquidity pools can be complex. You may be deemed to exchange assets for pool tokens. NFTs are property. Some art-centric NFTs risk collectible treatment and higher rates. Because guidance is evolving, document flows, addresses, and intent and model alternatives. Let's handle losses, wash sales, and jurisdictional issues. Capital losses offset capital gains, plus up to $3,000 of ordinary income each year, with the rest carrying forward. Business theft or casualty claims face strict standards. Build a file for rug pulls or exchange failures with dates, amounts, chain evidence, communications, and any legal actions. Statutory wash sale rules currently target stocks and securities, not most crypto, but the IRS can attack transactions lacking economic substance. So, avoid buybacks that eliminate market risk. Missouri generally conforms to federal gain and loss rules. Always verify current law. If you hold assets abroad, monitor evolving FBAR and FATCA requirements and keep account inventories. Two powerful planning areas, giving and estimates, plus a word on controls. Donating appreciated tokens to a qualified charity can erase the capital gain and generate a deduction for fair market value. Larger gifts may need an appraisal and Form 8283. Gifts to individuals carry over basis and holding period. For cash flow, use estimated tax safe harbors, often 100% of last year's total tax, or 110% for higher incomes, so you are not forced to sell at a low. Build a dollar-denominated reserve wallet. Finally, strengthen controls, segregate business wallets, use multi-sig, define who can initiate and approve, reconcile monthly, and document pricing sources. Let's land with quick case studies and an action list. A cafe accepts Bitcoin and auto converts. Ordinary income equals the latte price in dollars, and sales tax applies as usual, clean and low risk. A contractor is paid in ETH, recognize business income at receipt, then track later swap gains or losses with specific identification. A miner formalizes as an S corporation, deducts hosting and depreciation, pays a reasonable salary, and may unlock QBI. Your checklist: pick software, write valuation and lot policies, separate wallets, reconcile monthly, run payroll and payables through compliant platforms, plan estimates, and review giving. When in doubt, call Premier Tax and Business Services. I'm David Robson. Thanks for listening, and here's to paying only what the law requires. Before we sign off, a quick recap and a promise of value. Today you learned the core rule, crypto is property, and how that drives income when you accept tokens, basis tracking, and capital versus ordinary character. We walked through lot selection, record keeping, new GAAP fair value rules, where things land on your tax return, and what broker reporting may soon surface. We covered payroll and tokens, mining and staking logistics, airdrops and forks, DeFi swaps and NFTs, loss documentation, wash sale pitfalls, Missouri conformity, foreign reporting, charitable strategies, estimates, and the internal controls that protect both assets and deductions. If one takeaway sticks, make it this: systematize. Policies, software, reconciliations, and timely estimates turn chaos into clarity and keep more in your pocket. When you want experienced help, Premier Tax and Business Services is ready to build a proactive plan around your wallets, workflow, and goals. I'm David Robson, and this has been Tax Smarts Unlocked, where smarter planning beats bigger tax bills. See you next time. Subscribe, share this episode with a business owner friend, and send your questions. We'll tackle your most requested crypto tax topics in future shows together.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.